This is Business Weekend.
Hi and welcome to Business Weekend. I'm Edward Boyd. Coming up on the program, we recap a busy 2 weeks of news for Reserve Bank Governor Philip Lowe. We've had a cash rate rise and the review into the RBA has started. We'll speak to Economist Peter Tulip, who's taking part in that review. Stock markets plunged this week on inflation fears, and that's hurt the superannuation balances of everyday Aussies with a super fund. I speak to Deanne Stuart, the Chief Executive of Aware Super, Australia's third largest super fund.
Without a doubt, climate change risk is the biggest risk in an investment portfolio today.
I also catch up with Steen Jacobsen, the Chief Investment Officer at the Danish investment bank Saxo Markets. He'll provide us with a global view on what he sees the major supply and demand challenges the world economy is facing.
I think there will be support for the Australian economy, for the Aussie dollar over the next 6 to 9 months from China.
And rising interest rates have wiped out tech shares this year. A lot of companies are slimming down and cutting costs, but small business accounting software company Xero is still hiring. I sit down with its chief executive, Steve Vamos.
Certainly for small business, getting paid faster is a real key issue.
But first, to our top story. We finished this week with Governor Lowe at the House of Representatives Economics Committee in Canberra. He told the committee interest rates will need to keep rising to bring down inflation. And he said lots of households will have a difficult time with mortgage repayments over the next few months.
I know, and I've said this before, it's very difficult for people, but it will be even, this is the point, it'll even be more difficult if inflation stays high. If you've got a mortgage, you don't like higher interest rates, so you understand that, and it hurts. But having inflation high for a long period of time will mean higher interest rates and fewer jobs, and that will hurt a lot more. So I know it's unpleasant for this year, but I ask people to look through this year, and if we can manage this successfully, then we can look forward next year with rising real wages again.
Lowe's testimony was just a glimpse of what he's going to face in the upcoming independent review commissioned by Treasurer Jim Chalmers. Joining me now in the studio is Peter Tulip, Chief Economist at the Centre for Independent Studies. He previously worked in the research department for the RBA. Peter, thanks for your time today. Have you been involved in this review with the Reserve Bank?
Yeah, I actually appeared before the panel earlier on in the month, and we had a discussion about a lot of the issues facing the review.
Was it a very animated discussion?
I got animated. I have strong opinions on these things. They asked a lot of questions. They were very curious. They've clearly done their homework. They read my research papers on the topic, for example, and were asking questions about that.
Did you get was there anything specific that they were really getting into you about, or?
So they've just put out an issues paper, and the stuff that we talked about in our meeting was very similar to the material in the issues paper, that they're interested in issues of transparency, culture, the specification of the mandate, and issues of governance. And so they cover, what I think the key issues facing them. So I was impressed.
Yeah, the issues paper actually came up in the Governor Lowe's appearance before the Parliamentary Committee on Friday. And one of the things was whether the RBA should disclose which board members vote yes or no to cash rate rises and disclose that to the market. What's your take on that?
Oh, I have a strong view that they should disclose votes, and they should give explicit reasons why people disagree. That at the moment, these discussions are confidential, so the public has no idea what are the leading issues in monetary policy, and the public is disenfranchised from any discussion of those issues, which I think is a big problem. But also, if individual board members have to say how they're voting and why, that makes them individually accountable for performance, and they can be held to account when things go bad.
Yeah, well, Governor Lowe said on Friday that if members' votes are recorded, then that member could be subject to lobbying. How do you react to that?
I mean, that's the point of the exercise. Now, it does raise an interaction with how they're selected. So some people, for example, have said we should have an ACTU representative on the board, or maybe a representative of the welfare sector, and if you go that road, then maybe the farmers and the miners and the retailers, everyone should call for their own representative on the board. that would be a big problem if they had to represent their sectional interests. That if you do have public votes, you need to appoint experts who take the national interest into account. They're not there to represent sectional interests.
Look, another thing in the issues paper is, does the Reserve Bank need a specialist monetary policy board? What do you think about that?
Oh, I strongly think it does. In fact, I think that's the most important reform that I hope comes out of this review. That one of the reasons we're having this review is that the bank has made big mistakes in the past. And partly it makes those mistakes because there's no one on the board. There are too few people and they're too ill-equipped to challenge the governor. So that if the governor makes a mistake, which he will do from time to time, he's only human. He's a very good economist, as have been his predecessors, but they're just one individual, they're human. And we don't have any real checks in the system to make sure that things are properly thought through.
Another thing that's popped up the last couple of weeks has been the Reserve Bank providing that 2024 guidance for saying interest rates are probably unlikely to rise until then. Governor Lowe's now said they're going to be a bit more vague with their language in the future. What do you think the public reaction has been to that?
I think the criticism of what the Reserve Bank did is very unfair and is not really thought through. That during the pandemic, the RBA tried to give its best guidance and its best information as to where we were heading, and that was very useful, both for individuals in their own decisions, but also for the Reserve Bank. That the idea, the expectation that rates would be low for longer encouraged people to get out and spend. So that was helpful. And now to criticise the Reserve Bank for essentially what was a forecasting mistake, I think is ill-considered. The people that are making these criticisms haven't tried to do forecasting. It's difficult. And those of us that do it, we make mistakes all the time. You can't have the central bank giving clear information about the basis of its decisions if politicians are then going to call for your resignation whenever there's a forecasting error. It doesn't make sense.
Yeah, the governor also said that a lot of central banks around the world got their inflation forecast for this year in particular wrong. He said no one could predict the war in Ukraine pushing up energy prices. How difficult is it to do these sorts of economic forecasts?
Oh, well, normal forecasts are difficult, and this one was almost impossible. They were in the middle of a pandemic, remember? A 1 in 100 years event. There was no historical experience really to draw upon. And what eventually, and they did, they consulted with experts, of course, and formed their best judgment on the available information. But what happened was that the vaccines worked much quicker than we were expecting and came in much earlier. And yes, I didn't see that coming. The RBA didn't see that coming. Mistakes, and as a result, we're recovering much quicker than anyone was expecting a few years ago. So it's, I think, a perfectly understandable, forgivable mistake.
The governor's also suggested he believes house prices in Australia may fall 10% over the next 12 months. But he says the next couple of months are going to be pretty tough for quite a lot of Australian households as those cash rate increases start to be felt by them paying more on their mortgages. How tough a time period do you think we're about to enter for Australia's economy?
So it's going to be mixed. Some people, particularly those that have recently borrowed big mortgages, will be hurting. But you have to remember we've got the lowest unemployment rate in generations, 3.5%. So and this is arguably the most important measure of hardship in the economy. And by that measure, the unemployment rate, things are unusually comfortable. So Phil Lowe is trying to take credit for it. You can debate how much credit he gets, but it's undeniably a good thing that we should be very happy with.
And Phil Lowe, this review into the Reserve Bank, doesn't come out till March next year. Phil Lowe's obviously under quite a bit of pressure at the moment. His term finishes in September. Do you think the next governor of the Reserve Bank, should that be an internal or an external appointment?
That external would be good. I mean, so in fact, some central banks, like the Bank of England or the Bank of Israel, have appointed people not just outsiders, other economists from their country, but they've gone overseas to recruit their heads of a central bank. And there's no reason the Reserve Bank shouldn't be in the international market for a governor. There are also talented individuals inside that need to be considered. I don't want to talk about personalities. Some of them are my friends.
I'll look, Peter Tulip, Chief Economist at the Centre for Independent Studies. Thanks for your time today.
Pleasure.
Global markets plunged this week on inflation fears, particularly the Nasdaq in the United States. Markets are now pricing in a 75 basis point rate increase from the US Federal Reserve next week. And that fall in the markets has hurt the superannuation balances of everyday Australians. I caught up with Deanne Stuart, the Chief Executive of Aware Super, Australia's third largest super fund, talking asset returns, investment opportunities and merger and acquisition deals.
Yeah, it's been a really challenging last 12 months, no doubt. And when you look at what's going on in the markets, with really significant headwinds really impacting the market. So if you look at the 12 months to June 30th, you literally had the ASX down over 10%, you had the S&P down over 12%, you in fact had Nasdaq down over 20%. So you had really significant downfall in markets. Most of the super funds, though, like Aware Super, because we're so diversified, certainly we had negative returns for the 12 months, but they were really in low single-digit negative returns. And that's just the power of diversification. So we've got assets like infrastructure, property, private equity, as well as equities, cash and fixed income. And so that diversification actually really does help protect members, both in the short term, but particularly in the long term.
Can you just sum up the state of the Australian market at the moment? Are there still plenty of investing opportunities in Australia, or are you now focusing overseas?
Yeah, look, it's definitely a period of lower returns and of very volatile markets. But for us, we're seeing plenty of opportunities, both here in Australia and internationally. And certainly a fund of the size that we are, 150 billion, you've really got to make sure that you are investing both in international markets and opportunities as well as here in Australia. Here in Australia, we certainly really want to participate and are participating in some of the really big investment themes like the energy transition. Lots of opportunities both now and into the future that we're looking forward to being a major participant in. But also in things like, for example, build to rent. That's a really nascent segment here in Australia, but we see really significant opportunities there and are one of the lead investors here in Australia. Similarly, overseas, though, we've also participated in really significant developments, whether it be ports, whether it be major infrastructure, or indeed service departments, build to rent in both the US and in the European markets. So we certainly look to invest in both where the best opportunities are for our members.
You talked about the energy transition. How mindful do you need to be of infrastructure assets emitting carbon?
Hugely. So without a doubt, climate change risk is the biggest risk in an investment portfolio today. No matter which industry you're looking to invest in or which asset you're looking to invest in, the ability for that asset to adapt and transition to a lower emission profile is critical. So we've certainly been able to do that more easily in our listed equity portfolio because a lot of listed companies do disclose what their carbon footprint is. What we've now done in all of our unlisted assets, so our properties, our infrastructure, is actually baseline the carbon emissions of each and every one of them. And now we're on a pathway to reducing those emissions over the next 5 to 10 years. That is a mammoth undertaking, but a really critical one to be part of the net zero for both Australia and globally.
And is this something you think all super funds are starting to get into? Or?
I certainly think so. I think different super funds are at different stages as it. We'd like to think we're really leading the way. We certainly led the way on what we've done on the listed equity side. I think we're one of the first to have baselined our entire unlisted equity portfolio. So I think we certainly feel like we're leading the way, but my understanding is a number of other funds are looking to do something quite similar.
And how much of that change has come from your own super fund members who want you to start doing these sorts of things?
Oh, there's no doubt that our members want to do that. If you look at certainly Aware Super, our fund, at the heart of our fund, we're certainly open to all Australians, but given the history of it, we've got a lot of essential workers. So you're talking about teachers, nurses, doctors, fireys, police officers, people at the front line seeing the impacts of climate change. So if you looked at letters that come into our fund, I could guarantee that the number one reason for letters into our fund is what are we doing around climate change. So they are certainly care deeply about what we're doing, and we certainly communicate that very regularly as to where we're at and what we're doing going forward.
And how quickly can you make a decision on an M&A deal? Because you've done a lot of deals over the last 12 months.
Yeah, it's really true. We certainly have done a fair amount. So we've done things like taking Vocus private, for example. We've been a lead in that consortium, taking Vic Roads, working with the Victorian government, for example. So we've done a fair amount. Together with mergers in the super industry, we've actually undertaken several mergers there. From an investment perspective, exactly what you just said, our team we've really over the last 5 years built out the right capability and skill, both to be able to undertake these sort of investments, but exactly to what you just said, is to be able to go at speed. And we think it's one of our competitive advantages, is that we can actually take on one of these deals. We've got the right capabilities, the right skills, and the ability to do that at pace is actually a competitive advantage. But so too is the ability to play right across the capital structure. So whether it's debt or whether it's equity, we can certainly play on both sides and have sort of the key resources and capability to do that.
You mentioned your build-to-rent portfolio. I know you're trying to grow it to be $7 billion in size, but rental vacancies around some of Australia's capital cities are around the 1% mark. So is that a big driver behind that build-to-rent portfolio?
Absolutely. If you look at Australia at the moment, we have a housing affordability crisis. There is no doubt about that. And one of the huge contributors to that is the lack of supply. And so build to rent, while it's not the full solution, it is actually a really core part of it, particularly for young people coming through. Rent is really high at the moment. You look over the last couple of years, it's increased 15 to 20% per annum. There is a lot of Australians hurting and not able to pay their rent. So increasing the supply of really affordable, high quality apartments is a really core part of our strategy. We've got in our pipeline now about $1.5 billion, but as you said, we'd like to continue to scale that up. We see it as a really good investment opportunity for our members.
With the change of government, has there been any changes to the way that you go about your business?
Look, I certainly think over the last couple of years there's been some really significant changes from a regulatory perspective. From our strategy perspective, I think we probably anticipated a number of the big themes playing out and have really adjusted our overall organisation accordingly. So if you look at some of the big themes, they would be two of the biggest is the consolidation in the market. So instead of there being 150 odd super funds, we certainly see there being a much smaller number, certainly a very competitive field, but certainly less than 150. And so we've really led the way on that front. We're undertaking several mergers over the last couple of years because we think scale matters. Why does scale matter? Because ultimately what you want to do is lower the cost to serve for members and lower the fees for our members, because we are a profit for member fund. We want all the benefit to go back to members. So that's been one of the big changes that's occurring, and the regulatory environment has really led it that way. The other big theme is around choice. And ultimately, as the market moved from just being more default orientated to being Australians choosing what super fund, then that's why you're certainly seeing players like Aware Super do a lot more in the space of really making sure that their brand is known and really making sure that what we're doing is exactly what members value. And so for us, for example, we've spent a lot of time, energy and dollars in really building out our advice proposition, because while members really want good returns, that's exactly what we're there to do, really good retirement income, they also need the help and guidance and advice at times, particularly when they're nearing retirement. And so we really want to get the two right and really lead the way in both of those elements.
And do you think super funds now have more of a seat at the table when it comes to communicating and interacting with government, given Labor's history of coming up with super?
Look, there's no doubt that superannuation is huge and significant. It's $3.5 trillion now. That is the third largest asset pool in the world. Now, that's really significant when you consider we're the 13th largest economy, so it gives you a sense of just how successful the superannuation system has been. So certainly as that relates to then interacting with the government, if you think about a couple of the government's priorities, whether it be the energy transition, whether it be housing affordability, certainly the role that super funds can play is significant in that. but only when and if it really creates really good returns for our members. So that's certainly the conversations that we're having with the government at the moment.
Deanne Stuart, Chief Executive at Aware Super, thanks for your time today.
No problem, Ed. Thanks very much.
Coming up after the break, is the world hurtling towards a recession? I speak with the Chief Investment Officer of Saxo Markets, Steen Jacobsen. Plus, a check-in on the health of Australian small businesses with CEO of cloud accounting company Xero. Welcome back. This week, the US inflation numbers surprised the market, which has increased the chances of a 1% interest rates hike by the US Federal Reserve on Thursday. At the same time, there are still supply chain shortages, rising power prices, and China's COVID-0 lockdowns. So is the global economy heading towards a recession? I spoke earlier with Steen Jacobsen, the Chief Investment Officer at Saxo Markets.
So the problem is that the classic analysis sort of goes after what we economists call the aggregate demand. So we monitor how much demand you have as a household, as a business. The constraints of the world right now is on the supply side. So going to the inflation and inflation story, it's very difficult to resolve to a lower inflation rate if you don't solve for the supply shortages of the economy. So the answer is straight up, absolutely not. Everybody is in a global cycle. We did the globalization. As we deglobalize or fragment the world economy, we are increasing the pressure on actual prices going up relatively to down.
Yeah, the RBA governor says Australia is on a narrow path. He's expecting rates to keep rising, but at a slower pace. Do you think he knows where rates in Australia are going to end up?
I would qualify that by saying, I don't know, and I'm absolutely certain the RBA has no clue where the economy is going or where the impact is going to be from all this. You have to remember every economic decision is a massive decision tree where you have path dependency on the different decision. In case of the RBA, first you need to define what is a narrow path, but that path is an illusion. That what is going to happen is, of course, that we will reset the mortgage rate in Australia higher. It's particularly an issue for 23. But the good news is that the balance sheet of the private sector, the wealth accumulated during the pandemic because of the handover from the government is very high. So in other words, a very good starting position from the financial asset side, which means that the deterioration of data will be much, much slower than even the RBA expect, meaning that we're in this period of higher inflation, higher interest rate for longer because the aggregate demand is coming down too slowly for, again, and its supply side, which is constrained.
Yeah, there's expectations the cash rate here will get to 3.5% by next year. When do you think it might start to come back down again? So for interest rate to go back down, you need to see exactly what I just talked about, economic activity coming off. I've been around Sydney for 4 or 5 days now. The restaurants are pretty packed. Yes, some high expensive places are a little bit less visited than before. But overall, I don't think the Australians feels bad. FTSE weekend, everything is coming up in terms of the seasonality, the summer. It's not going to be the next 6 months. So what we need to look at is actually when the carryover from the mortgage market, which is a very big part of the portfolio for an Australian investor today, has an impact, and that impact will be in late part of 23. And let's talk US. Their inflation is roughly at a 40-year high. What are you expecting from Governor Jerome Powell next week when they make their cash rate decision? Could it be 1% increases?
So the market says it's a 33% probability that they move 100 basis points. But I think what the viewers need to understand is that there was a gathering among central bank governors in the US at what is called the Jackson Hole. There, Jerome Powell delivered a speech lasting only 9 minutes. I've been in this market for 30 years. I've never seen a central bank governor limit himself to 9 minutes. The conclusion from that is he needed to be very concise, very clear about what's going on. What he said essentially is that if we're going to make a mistake now, we want to be too hawkish relatively to being too dovish, meaning that will maintain the path of higher interest rate, which is going to ultimately create some sort of liquidity constraint. But again, we're talking about 23, not 22.
Now over in Europe, they've had high gas prices, electricity shortages, winter starts in a couple of months. How delicate is the economic situation over there?
No, yeah, that's a very interesting question. First of all, winter's coming, which I think is, is a Game of Thrones title that you threw in there very handily. What people need to understand is Europe is not about to switch off the electricity and then go into black. I mean, the European economy is similar to what I just said about the Australian economy. Private sector is doing well. The amount of debt is reasonable. And most importantly, all of the sort of increased pressure that you see in the household coming from food prices and energy prices will be compensated by fiscal handouts. In the UK, Prime Minister Truss already capped the energy bill per household at £2,500. The German government last weekend came out with $65 billion worth of support for the energy sector. The Swedish government ponied up with $23 billion for a margin call on the electricity sector. So, as we classically see in Europe, yes, it will slow down. There will be, impairment of the growth rate, but trust me, we are not going into a deep recession. And yes, we are ramping off the handover from energy dependency from Russia into alternative energy, LNG, and of course, most importantly, nuclear power.
Well, that's good if Europe doesn't fall into a recession. That'd be nice. But equities, they've had a tough week, really. Is there any particular sector that looks attractive at the moment?
Yeah, so everything I just said in what we talked about really says one thing, that the tangible side of the economy, or what we call the real economy, is way too small to cater for the aspiration and push that we see on fiscal, monetary and green transformation. So in other words, there's too much pressure on the real economy. It's too small in size. So if you want to come through the next 3 to 18 months in an environment, higher interest rate, higher inflation, you want to be investing into what is the real economy. And here we're talking defense spending, energy, we're talking commodities, we're talking cybersecurity, which is a real issue these days, and at least, and most importantly, probably also something like logistics. So if your viewers invest into the tangible asset, they're investing into productivity, which is, of course, part of the solution for increasing the supply.
The other thing we've seen is retail spending has still been very strong in Australia, and I just saw some figures from Britain. So what's the outlook for retail like?
Yeah, so we know actually because we can follow the freight rates on container ships, and most of the, of course, goods that are produced in that segment come still from Asia and in particular from China. And what we've seen is a massive drop in the rate, which means that the flow of consumers is actually reflecting that there's a huge amount of storage of, there's a lot of things already on the shelves that need to be cleaned out. But this is a cycle that self-cleans to some extent. So retail is going to come down by double digit, but it's not enough again to really hurt the consumers. They're really just pushing back. When you buy the next Apple phone, they're buying maybe only one winter coat instead of two, and that's sort of the adjustment that the household would do this winter.
Aussie dollar's also taken a bit of a battering. It's at 2-year lows. I think part of it might be to do with China's COVID-0 lockdown, but what's the sort of outlook like for currencies right now?
Yeah, so the world is being hit by three things simultaneously. The hawkish Fed that we talk about, the fact that we hike interest rate very aggressively. The strong dollar is another issue, which is also being reflected in the weak Aussie dollar. And finally, we have what is called quantitative tightening, a reduction of the support that is given from the central bank. So if you look forward into the next 3 to 6 months, we are probably going to ramp up against the maximum interest rate that the world economy can carry. And when we reach that point, we'll start to see a weakening of the dollar, improvement on the Aussie dollar. And referring directly to your question on China, what is interesting is people are almost as negative on China as they are on Europe. The point, though, in factual terms, there is what is called a credit impulse increase, which means that the credit facilitation into the Chinese economy by the authorities is actually positive. So what we do know is that 6-9 months from now, activity will be higher. The problem, of course, is what is the base from which we have higher activity? Is it 0, is it -2, or is it 2? But nevertheless, I think there will be support for the Australian economy, for the Aussie dollar over the next 6 to 9 months from China.
Steen Jacobson, Chief Investment Officer at Saxo Markets. Thanks for your time.
Thanks for having me.
Australia's rental crisis has deepened, with national vacancy rates in August falling to just 0.9%. Once renters have found a place to live, they then have to deal with steep rent increases. In some cases, renters receive 2 letters from their landlord, a rent increase notice, along with an immediate eviction notice. So the renter has to choose, do I pay the extra rent or do I find a new home? Philip Stempion reports.
Earlier this year, Amy Croft was hearing stories from her friends that their rents were being increased. Then her own landlord lifted her rent by 10%. And then she received an email she never thought she would get.
I got an email from the real estate agent just saying that the lease is being terminated with no reason and I have to be out by the 1st of December.
It's a situation that the tenants union is becoming more and more familiar with.
We see cases where people are offered the rent increase notice and the eviction notice at the same time and told to pick one. And that really puts a huge amount of pressure on someone to accept the rent increase that's being put in front of them because they are going to lose their home if they don't.
And the New South Wales Tenant Union is seeing rents across the state increase on average by $45 or 9%. In the last few months, rents in the inner city CBD area have increased by 10%.
And so we get into this situation where people are desperate, they're offering extra money, they're offering rent well in advance to try and get that edge, to try and secure a home for themselves and their family. And that creates some really distressing and upsetting situations for people.
It's a situation that Amy has seen in her own search for a new home.
As I was inspecting one place, and it was a place I applied for and got rejected for, there was a guy pleading with the real estate agent. He was quite desperate. I think he was new to the country. He's come from South America or somewhere. And he was like, I put in an application. I'll offer more money. How do I offer more money? I just need this place. Please let me offer more money. So you can kind of see people getting just more desperate.
So what are the factors driving rents around the country? The simplistic answer is supply and demand.
First of all, we're starting to see the population grow again. International students and migrants are coming back. At the same time, we've seen a lot more property investors sell up than buy over the last couple of years, and that's dramatically reduced the total number of properties out there available for rent.
According to property data outfit SQM Research, in August, residential vacancy rates fell to 0.9%. The last time vacancy rates were this low was in April 2006.
I think that with the closure of the borders, rental vacancy rates would have actually risen, if anything, given the ongoing supply of new properties, but they didn't. They fell and they've fallen dramatically to levels we have not seen in a very, very long time.
A driving factor behind vacancy rates falling is landlords pulling their properties from the market.
We note that in the city of Melbourne, for example, there's currently more properties advertised on short stay accommodation websites than what there is for long-term leasing. And we're not talking about just holiday homes here, we're talking about your standard suburban home now being more available on these short-term stay websites. So that's definitely driven down the availability of stock in the long-term leasing market.
So why would landlords pull their property from the market when supply is so tight? President of Australian Landlords Association, Andrew Kent, says hostile legislation is to blame.
Changes in legislation are impacting not only on the returns for landlords, but also significantly impacting on the risk. So what we're seeing is, for instance, the Queensland government's just put through some legislation that means that your land tax in Queensland as of next financial year will be calculated based on what property you own throughout Australia, not just the property that you own in Queensland. So that's one example of what we would call some hostile legislation which is causing landlords to leave the market.
So what is the solution?
We need supply of genuinely affordable housing to really ease the pressure on all those people looking for a home at the moment.
Rising interest rates have been causing investors to sell their technology shares, and small business accounting software company Xero is no exception. Its shares are down about 40% this year. But Chief Executive Steve Vamos says the world is still in the early stages with cloud accounting software, and there are plenty of opportunities in the market for Xero's system. I caught up with Steve on the sidelines of XeroCon, a conference in Sydney that attracted thousands of customers.
Well, XeroCon is a big conference that we run. Used to run every year, and we're glad to be back on that cycle. where we bring our accounting and bookkeeping partners together to really talk about what we've achieved and what the future looks like for really making sure that we continue to drive digital technology and software in to support the small business sector.
How important is events like this for Xero with building up your brand and finding and retaining customers?
Well, look, I think the innovations that Xero represents really start with moving accounting into the cloud. We were the first to do that and first to do it in New Zealand, and really encourage accountants and bookkeepers to work a different way to connect with their small business clients in real time through the cloud software that provide a much better insight to the performance of a small business, to the areas where they need to focus. So it is really important because this is the embodiment of what makes Xero different and special. It's that partnership. It's about the more than 1,000 applications that connect to Xero. Being able to walk the exhibition floor and see the amazing range of solutions for small businesses of different kinds is really encouraging as well. So it's really about putting energy into the system to say the job's not done. We've still got a long way to go to get more and more small businesses benefiting from what Xero and other cloud software solutions can do for them.
Yeah, how challenging is it to get a bookkeeper that's set in their old ways to shift to start thinking about using the cloud?
Look, it varies. You know, we've got people in this audience that were right there at the very beginning when Xero wasn't even a complete solution because they're very innovative. It's very much a human thing. We all respond or think differently about change. And so we've got the innovators, and then we've got, through COVID, a lot of firms that adopted Xero because now they had to work in the cloud. They couldn't physically connect with their client base. So, you know, we have seen an acceleration in adoption through what happened in COVID. And what we have to really do now is make sure that those adopters and the small business clients they have really get the full benefit of the software that we're providing.
So how many years into this adoption of cloud accounting software are we? Are we at the early stages?
I believe we're, if you want to compare it to, say, consumer internet, we're sort of where consumer internet and what it was like for us when we were using the internet back in the late 2000s. So there's been about a decade of really solid adoption, but there's a long way to go. This is the last frontier, is making sure small business benefits the way consumers do, the way that large enterprises have, is really what we're about, is to bring the benefit of technology to that sector.
Yeah, your software gives you a lot of insights into what businesses are thinking. What do you see as some of the big challenges that businesses are facing at the moment?
Yeah, look, I think that they're pretty well documented right now. Inflationary pressures, certainly for small business, getting paid faster is a real key issue because, right now, in a sense, they're funding late payments through their working capital and other means. And at the end of the day, what we want to do, and through Xero, what they can do is get paid faster and make that process more efficient. So really managing cash flow is important. Getting access to people and staff is also another one of the things that many small businesses are challenged with right now. It is an interesting time, that's for sure.
How big a deal do you think skills shortages are for those small businesses?
Look, I think that at the moment, the sense we get is that it is a significant concern. I think that, just anecdotally as well, when you look at the way that many small businesses are changing their trading times to adapt to the staff they have available. So I think it is a real concern.
When you look at your overall suite of clients, what's the big sort of clients for you? Is it those bookkeepers? Who is it?
Well, it's really two-sided in that we work with accountants and bookkeepers to get them to streamline their workflows, and by doing that, they encourage their small business clients to use Xero. And then, once those small business clients are using Xero, there's a whole range of applications and services on show here at XeroCon that they can use to really go further to make their business even more efficient.
And there's obviously those inflationary pressures you've talked about. Are you seeing any signs of businesses being under a lot of financial stress or starting to go under?
Yeah, look, at this stage, a little bit early in the cycle to see that. So I think not overwhelmingly at this point, but we obviously keep a close watch on that.
You've also got obviously operations in the UK, North America, as well as Australia, New Zealand. There's inflation in the UK and the United States is a bit higher than Australia. Are there any big sort of differences you can see between those economies?
Yeah, look, I think it's really interesting, that many of these trends are consistent around the world, and I think that's maybe a reflection of globalisation, but also the fact we're all coming out of a couple of years of living in a pandemic world. So I think there are many of those trends to different degrees. They vary, but they're generally very similar.
We saw the Reserve Bank lift interest rates in Australia this week. Is that making it more difficult for companies to access capital with the cost of funding going up?
Yeah, look, it's a bit hard to say generally in that context, but one thing we do know is that small business has always been challenged in getting access to capital. And one of the things we're innovating in is exactly that space with a company we acquired called Waddle. We're looking at innovative ways to enable small businesses to get access to capital in a much more efficient way that wasn't possible before when they weren't using technologies like Xero.
The technology sector's been under pressure this year. Nasdaq's down more than 20%. Xero still keeps hiring and growing. What's the big differences with you guys?
Well, look, I think when you look at the size of the opportunity we have, you've got to think long term. And even in tough economic circumstances, the one thing we do know is that what we have to offer benefits the accountant, the bookkeeper and the small business that use it. So that enables them to be more efficient and deal with challenging circumstances even more effectively. So we retain a growth mindset and we also retain a long-term mindset when we look at our business and its settings.
Your financial year started on the 1st of April. How's it been tracking?
It's a bit early to say. We'll certainly talk more about that when we get to our results in November. But overall, as we said at our AGM, from a revenue perspective, we're on track.
And I looked and saw customer churn internationally seems a bit higher than Australia and New Zealand. What's the big differences there?
The difference is really the profile. So if you look at the adoption of cloud accounting in Australia and New Zealand, we are world leaders. I mean, this is actually a really fascinating story. The collaboration between Xero, our partners, financial services sector in Australia and the government, which has been a real supporter of digitisation, has meant the environment here for adoption is well ahead of the rest of the world. So the way to look at it is that in other markets around the world, we're not as far down the journey, and so there are more newer clients coming on board and learning to really get the benefits of cloud accounting.
My Uber driver today also works as a barber and did have Xero for about a year, but then he changed to a competitor because he said it was cheaper and less complicated to use. How tough is the competition in this space? Yeah, look, competition is an interesting reference point always, but in a marketplace like ours, which is so undeveloped and so underpenetrated, most of the challenges are, of your own making. So, we're constantly looking at how we can do better, and it's disappointing occasionally for a customer to hear that. But the interesting thing is that Xero is, to this point, an accounting solution. And some more simple, expenses type programs are out there. In fact, we just launched in the UK a program or a product aimed exactly at that audience, which is called Xero Go. So we're testing that and learning from that experience in the UK, and that'll give us something more suitable for someone that has very, very basic needs. And just how big is the opportunity out there in this cloud space? I think it's massive. I think when you look at the number of small businesses that are out there around the world and how many are actually getting benefit from this technology, you're seeing a massive potential for growth. Well, Steve Vamos, Chief Executive at Xero, thanks for your time. Thank you. Good to see you. After the break, 10 years of Uber in Australia, we look back at the technological and cultural innovation. Welcome back. The last decade has seen major disruptions to the way we do business. Convenience and flexibility are now at the centre of the modern workforce, which coincided with the launch of disruptive technologies like Uber and Uber Eats. Now celebrating 10 years in Australia, Uber can look back on its legacy as a game changer for Australian business.
When former pilot Ross Bridgman lost his job due to COVID in 2020, he never expected a short-term gig would lead to what he's doing now.
The very first job I had was up in the hills behind the Gold Coast, and I was given this address, and I turned up at this address and I couldn't find the house. The lady I was picking up was living in the trees, and that journey of 30 minutes changed my whole thinking pattern about Uber. By the time that ride had finished, I knew that was my first person I needed to help. So the angle of trying to get her into some sort of accommodation, and so that started the journey of 300 people plus in that sort of area about trying to help people with accommodation.
Since launching in Australia 10 years ago, Uber has changed the way we move around our cities. It has given rise to the ideologies of flexible work, the gig economy, and the side hustle.
Oh, it's a big day for us here in Uber. 10 years from nothing, launching with Uber Black in 2012, then Uber X in 2014, Uber Eats in 2016. And since then, we've done 1 billion trips and deliveries here in Australia.
Uber today is operating in 43 Australian cities with 3.8 million active riders and more than 700 million rides taken in Australia since launch in 2012. Its food and grocery delivery business, Uber Eats, is now operating in 30 Australian cities. There are over 30,000 restaurant partners on the platform. More than 11 million Australians have ordered Uber Eats, with over 450 million deliveries made since launch in 2016.
We do roughly 150 orders on average per day, every day, 365 days a year. We added staff, obviously, and with COVID, we probably would have lost half of them, but because of Uber Eats, and I mean Uber Eats, we kept all of them. So 30 plus staff, we kept them all, and that's only because of Uber Eats.
Its disruptive technology has allowed everyday Australians to take part in an ever-growing gig economy.
It really means that I can work whenever I want. I can earn as much or as little as I want if I, want to put in a hard week, that I do, and make some pretty good money. But then if I just want to take it easy, work on my side hobbies or go for a surf or catch up with friends, then I've got that flexibility as well.
10 years on, Uber is continuing to champion the side hustles of drivers and delivery partners.
We're really excited to announce today a business booster fund. What that is 100 drivers and delivery partners over the next 12 months will get access to a program of bespoke one-on-one mentoring and business tutelage. Things like cash flow management, marketing, raising capital. And we'll also give each of those drivers and delivery partners $2,500 cash injection. And at the end of the 12 months, they'll be able to pitch for up to $50,000 of additional capital into the business.
The challenge for Uber in the next decade? To empower aspiring business owners to take the wheel on any opportunity to maximise growth.
We were recently voted the #1 change that's occurred in Australian transport over the last decade. But mark my word, if we do everything that we want to do over the next decade, that'll pale in insignificance compared to what it'll look like in 2032. We have so much opportunity here in Australia that we can't wait to bring our platform to help solve.
That's all for the show this Sunday. Up next is all the latest news right here on Sky News. Business Weekend returns next Sunday, but don't forget you can keep up with all the latest business news with our daily program Business Now at 4:30 p.m. Eastern Standard Time. Thanks for your company. I'm Edward Boyd. We'll see you next week.